stop what you're doing. Because something just broke in the bond market and almost nobody noticed. Not because it was hidden, because it was boring. It was dressed up as normal. It was processed through the usual channels. It was reported in the usual language. But underneath the polite surface, something failed. A government held an auction, debt was offered, buyers were expected, and the buyers didn't show up. Not in the dramatic way that makes headlines, not in the way that triggers panic, but in the quiet way that reveals cracks. The auction cleared, technically, but the numbers tell a different story. A story about demand that wasn't there, about buyers who stepped back, about a system that had to absorb its own issuance because the market refused to. And here's the part that should make you uneasy. This didn't happen in some fragile emerging market. This happened in a country that's supposed to be safe, a country whose bonds are supposed to be the anchor. So if the anchor is drifting, what does that say about everything tied to it? Before we go any deeper, I need to ask you something that takes 2 seconds, but matters more than you think. My analytics show a massive chunk of you are watching these breakdowns all the way through, but you still haven't subscribed. If you value this kind of work, hit subscribe right now and drop a quick comment. Even just Arjon AG, so the algorithm knows this is original content worth pushing. All right, let's start with what actually happened, because the details are where the truth lives. A major developed nation held a regularly scheduled bond auction. This is routine. Governments do this constantly. They issue debt to fund operations, refinance maturing bonds, and manage cash flow. It's the circulatory system of public finance. And for years, these auctions have been smooth, predictable, almost boring in their consistency. But this time, something was different. The bid-to-cover ratio came in weak. For those who don't live in bond market terminology, the bid-to-cover ratio is simple. It measures how much demand there was relative to how much debt was offered. If the government offers $10 billion and receives $20 billion in bids, the ratio is 2 to 1. That's healthy. That's strong demand. It means investors are competing for the debt. But when the ratio falls, when it approaches 1 to 1 or even dips below in extreme cases, it means demand is thin. It means the market isn't hungry. It means buyers are hesitating. And that's exactly what we saw. The auction cleared, yes, but it cleared with less enthusiasm than usual. And in bond markets, enthusiasm isn't just a mood, it's a price signal. It's a confidence indicator. It's the market voting in real time on whether it trusts the issuer. Now you might be thinking, okay, but 1 week auction doesn't mean the system is collapsing. And you're right. 1 week auction is a data point, but it's a data point that only matters when you understand the context. And the context is this. We are living in an era of record debt issuance. Governments around the world are borrowing at levels that would have been unthinkable a generation ago. And that borrowing has to be absorbed by someone. Pension funds, insurance companies, sovereign wealth funds, foreign central banks, retail investors. Somebody has to buy it. But what happens when someone starts stepping back? What happens when the traditional buyers, the ones who used to show up reliably, start reducing their appetite? What happens when foreign holders decide they'd rather hold their own currencies or diversify into other assets? What happens when domestic buyers get nervous about duration risk in a world where inflation isn't dead and central banks are stuck between conflicting mandates? When those buyers step back, the auction still has to clear. The debt still has to get sold. So who steps in? That's the question. And the answer is, what makes this story so dangerous? Now let's talk about what a bond auction actually is, because most people have never thought about the mechanics. A bond auction is not a physical gathering. It's a digital process where approved participants submit bids electronically. They specify how much debt they want and at what yield. The government reviews all the bids, accepts the ones that meet their needs, and the auction closes. The debt is issued. The buyers receive their bonds. The government receives cash. Simple. But here's the part that matters. The government doesn't just accept any yield. They have a target range. They have expectations based on prior auctions and market conditions. And if the bids come in demanding higher yields than expected, that's a problem. Because higher yields mean higher borrowing costs. And higher borrowing costs mean more of the budget goes to interest payments instead of programs, services, or investments. So when an auction struggles, when demand is weak and yields have to rise to attract buyers, it's not just an inconvenience, it's a structural cost increase. And if that pattern repeats, it becomes a debt spiral. More borrowing, higher rates, more interest expense, more borrowing to cover that expense, and the cycle feeds itself. Now, here's where the story gets darker. Because when demand is weak, there's a silent mechanism that kicks in, a backstop. A participant who doesn't need to be invited because they're always there, the central bank. In many systems, the central bank has the ability to purchase government bonds either directly or indirectly through open market operations. And when they do, they're not buying with deposits or savings. They're buying with newly created money, money that didn't exist until the purchase happened. That process has a name, monetization. And monetization is the line that separates a normal bond market from a controlled one. Because in a normal market, bond prices are set by supply and demand, real buyers with real capital competing for yield. But in a monetized market, the central bank becomes the buyer of last resort. And once that happens, the price signal breaks. The market stops reflecting true demand. It starts reflecting policy. And here's the trap. Once monetization starts, it's very hard to stop. Because if the central bank steps away, if they stop buying, yields can spike, and spiking yields can crash asset prices, destabilize banks, and trigger the exact crisis the monetization was supposed to prevent. So they keep buying. And the more they buy, the more the market expects them to buy, until the market isn't a market anymore. It's a mechanism. Now, let me ask you a question, and I want you to answer it in the comments. Do you think this recent week auction was an isolated event or the beginning of a pattern? Because patterns are what change the game. 1 week auction is noise. 3 week auctions in a row is a signal. And if the signal is that global demand for a major nation's debt is softening, that's not a minor development. That's a foundational shift. Let's talk about who the traditional buyers are, because understanding the buyer base is essential to understanding the risk. Historically, foreign central banks have been massive holders of developed nation debt, especially U.S. treasuries. Countries like China, Japan, and oil exporters accumulated reserves by running trade surpluses and recycling those dollars into bonds. That demand was structural. It was consistent. It was the bedrock of the system. But that's changing. Some countries are reducing holdings. Some are diversifying into gold, into other currencies, into strategic assets. Some are facing domestic pressures that require repatriating capital. And when foreign demand shrinks, the remaining buyers have to absorb more. But what if they don't want to? What if domestic buyers are also hesitant because they see inflation risk, currency risk, or political instability? That's when the auction room gets quiet. That's when the bids come in weaker. That's when the government has to accept higher yields to clear the debt. And that's when the cracks start showing. Now let's connect this to what's happening in other markets, because nothing exists in isolation. At the same time, bond auctions are showing stress. We're seeing record physical demand for metals. We're seeing persistent premiums in alternative assets. We're seeing capital flows shifting away from traditional safe havens. All of these are symptoms of the same disease, confidence erosion. When confidence in the system erodes, people don't just sell bonds. They reallocate entirely. They move into assets that don't depend on promises, assets that settle without counterparties, assets that can't be printed. And that reallocation creates pressure in places the system wasn't designed to handle. Now, I want to introduce a cliffhanger that you need to hold on to for the next section. If bond auctions continue to weaken, if foreign buyers continue to reduce exposure, if domestic buyers stay cautious, there are only 2 paths forward. Path 1, yields rise until demand returns. But rising yields destabilize everything. Path 2, the central bank steps in and monetizes the deficit. But monetization destabilizes the currency. Both paths end in crisis. The only question is which crisis arrives first. Now, before we go deeper, I want to mention something practical for those of you who want real-time updates when these moments hit. I've set up a WhatsApp channel where I share daily posts, instant voice notes, and quick alerts the moment something breaks. The link is in the description. Join it if you want to stay ahead, because these stories don't wait for upload schedules. All right, let's talk about the specific metrics that reveal stress in a bond auction, because this is where most people get lost in jargon. But the jargon matters. It's the language the system uses to hide problems in plain sight. So I'm going to translate it into something you can feel. First metric, bid to cover ratio. We already touched on this, but let's go deeper. A falling bid to cover means fewer participants are competing for the same amount of debt. That could mean buyers are worried about the asset. It could mean they're worried about opportunity cost. It could mean they're worried about getting trapped in a position they can't exit. Whatever the reason, weak demand shows up here first. Second metric, indirect bidders. This category usually includes foreign buyers. When indirect bidder participation drops, it often means foreign central banks or sovereign wealth funds are stepping back. And when foreign buyers step back, it's usually because they're either reducing reserve exposure or they're facing domestic needs that require capital at home. Either way, it's a reduction in the structural buyer base. Third metric, the tail. The tail measures the difference between the average accepted yield and the highest yield that was accepted. A large tail means the auction had to accept bids at much higher yields than expected to clear the debt. That's a sign of weak demand. That's a sign the market demanded compensation for risk. And when the market starts pricing in risk, it's because risk is real. Fourth metric, primary dealer takedown. Primary dealers are the banks authorized to participate directly in auctions. They're essentially the market makers. When primary dealers have to absorb a larger percentage of the auction because outside demand is weak, it signals trouble. Because primary dealers don't hold bonds forever. They're intermediaries. They buy at auction and distribute to end buyers. But if end buyers aren't there, primary dealers get stuck holding inventory they don't want. And when that happens, they start hedging, reducing exposure, and pulling back from future auctions. Now stack all four of those metrics together. Weak bid to cover, reduced indirect participation, large tail, high primary dealer takedown. When you see 2 or 3 of those in a single auction, it's a yellow flag. When you see all 4, it's a red flag. And the question you have to ask is, how many red flags do we ignore before we admit something is broken? Now, let's talk about the psychology of bond markets, because psychology is what turns data into disaster. Bond markets operate on confidence. Confidence that the issuer will pay. Confidence that the currency will hold value. Confidence that inflation won't destroy real returns. Confidence that liquidity will remain stable. When any of those confidence pillars wobbles, behavior changes. And here's the brutal truth. Confidence can evaporate faster than it can be rebuilt. It takes years to establish credibility. It takes one auction failure to destroy it. Not a literal failure where the auction doesn't clear. A psychological failure where the market realizes the buyer base is shrinking and the only reliable buyer left is the one with a printing press. That realization doesn't happen all at once. It happens in stages. First, a few sophisticated players reduce exposure. Then, larger institutions start hedging. Then, headlines begin whispering about auction weakness. Then, retail starts noticing. And by the time the public realizes what's happening, the repricing has already occurred. The yields have already spiked. The damage has already been done. This is why I keep saying the story is not the headline. The story is the setup. And the setup is happening right now. Now, let's talk about what happens when a bond market loses trust, because history gives us a playbook. When confidence breaks, several things happen simultaneously. First, yields spike. Investors demand higher returns to compensate for perceived risk. Second, currency weakens. If foreign buyers are selling bonds, they're also selling the currency. Third, inflation expectations rise. If the central bank is forced to monetize, people anticipate currency debasement. Fourth, alternative assets rally. Anything that's scarce, tangible, or outside the system becomes a refuge. We've seen this pattern before, not in developed markets recently, but in emerging markets, in historical crises, and in every situation where debt loads became unsustainable and the market stopped believing in the issuer's ability to service obligations without destroying the currency. And here's the uncomfortable question. If it can happen in emerging markets, why can't it happen in developed markets? The only difference is scale and the assumption of stability. But assumptions are not facts, and when facts change, assumptions break. Now, I want to introduce another cliffhanger because the next part is where this gets truly frightening. If bond auctions weaken and central banks monetize to fill the gap, the immediate crisis gets delayed. Markets stabilize, yields calm down. Everyone exhales. But the long-term cost is invisible at first. It shows up later as inflation, as currency depreciation, as loss of purchasing power. And by the time people realize they've been taxed through debasement, it's too late to undo. This is the hidden cost of monetization. It's a transfer of wealth from savers to debtors, from the prudent to the overleveraged, from those who trusted the system to those who gamed the system. And it happens silently, without a vote, without a debate, through the mechanism of currency creation. Now, let's connect this to metals, because this is where the story becomes actionable. When bond markets show stress and monetization becomes the path of least resistance, hard assets reprice. Not because they're magical, because they're outside the promise-based system. A bond is a promise, a currency is a promise, a bank deposit is a promise. But physical gold and silver are not promises, they're assets. And in a world where promises are breaking, assets become valuable. That's why you're seeing record delivery activity on exchanges. That's why premiums are persistent in certain regions. That's why vault inventories are being drawn down. Because informed capital is reading the bond market signals and repositioning before the public catches on. Now, I need to address something that always comes up in the comments. People say, but John A.G., if this is so serious, why isn't it on the news? And the answer is simple, because bond market mechanics are boring. They're technical. They don't produce viral clips. And more importantly, there's no incentive to alarm the public. Because alarming the public about bond market instability can become a self-fulfilling prophecy. If people panic and start selling, yields spike further and the crisis accelerates. So the strategy is always the same. Downplay, normalize, move on, and hope that confidence holds long enough for conditions to stabilize. But hope is not a plan. And conditions are not stabilizing, they're deteriorating. Now, let's talk about what you should be watching, because this is where awareness becomes advantage. First, watch auction results. Not just one auction, but the pattern across multiple auctions. Are bid to cover ratios trending down? Is indirect participation falling? Are tails widening? If yes, the trend is weakening demand. Second, watch central bank balance sheets. If the central bank's holdings of government debt start rising rapidly, it means they're absorbing supply that the market won't. That's monetization in action. It might be called quantitative easing or asset purchases or liquidity support, but the mechanism is the same. Newly created money buying government debt. Third, watch currency movements. If a nation's currency weakens while bond yields rise, that's a double signal. It means both the bond market and the currency market are losing confidence simultaneously. That's the setup for a crisis. Fourth, watch alternative asset behavior. If gold, silver, and other hard assets start rallying while bonds are struggling, it's a rotation out of promises and into assets. That rotation is capital voting with its feet. Now, I'm going to give you a scenario framework so you can think through what happens next. Scenario 1, the weak auction was a one-off. Demand normalizes, yields stabilize, the system continues. That's the optimistic case. But it requires foreign buyers to remain engaged, inflation to stay low, and confidence to hold. All three of those are questionable right now. Scenario 2, auctions continue to weaken, yields rise. The central bank steps in with measured purchases. This buys time but doesn't solve the structural problem. Debt keeps growing, demand keeps shrinking, and eventually the central bank becomes the dominant buyer. That's the managed decline scenario. It's not a sudden crash. It's a slow erosion of confidence and purchasing power. Scenario 3, a shock event triggers a loss of confidence. Maybe a geopolitical crisis, maybe a domestic political breakdown. Maybe another major buyer announces a large reduction in holdings. Whatever the trigger, confidence breaks, yields spike, the currency falls, and the central bank is forced into aggressive monetization. That's the crisis scenario. And in that scenario, hard assets don't just outperform, they become survival tools. Which scenario plays out depends on variables we can't control, but we can watch the signals, and the signals are already flashing. Now, I want to address the elephant in the room. If this analysis is correct, if bond markets are weakening and monetization is the likely path, why aren't more people talking about it? There are a few reasons. First, most market participants are either too close to the system to see the forest or too invested in the system to question it. If your career depends on bond market stability, you're not incentivized to sound the alarm. Second, the feedback loop between media and markets creates conformity. If everyone is saying the system is fine, dissenting voices get labeled as alarmist or fringe, so people self-censor. They hedge their language, they downplay concerns, and the consensus becomes a lie that everyone agrees to because no one wants to be the first to call it out. Third, bond market crises develop slowly until they don't. There's a long period where things feel manageable, yields rise a little, auctions clear with a little more difficulty, but nothing breaks visibly, and during that long period, people dismiss warnings as premature until the day the crisis accelerates and those warnings look prophetic. I'm not claiming to know the exact timeline. I'm claiming to see the setup, and the setup is ugly. Now, let's talk about the political dimension, because debt is not just an economic issue. It's a political issue. Governments borrow to fund programs, services, and promises. Those promises get votes. Those votes keep politicians in power. So there's enormous political pressure to keep borrowing, keep spending, and kick the consequences down the road. But kicking consequences down the road doesn't eliminate them. It compounds them. And at some point, the market says no more. Or rather, the market says we'll lend, but at a much higher price. And that higher price eventually becomes unsustainable. When that happens, politicians face a choice: cut spending and face voter backlash, or monetize the deficit and face currency debasement. Most choose monetization because the consequences are less visible and slower to materialize. People don't immediately feel inflation the way they immediately feel spending cuts. So inflation becomes the politically convenient tax. And that's why this bond auction story matters, because it's the beginning of a process that ends with currency destruction. Not next week, not next month. But over time, as monetization becomes the path of least resistance and the market accepts that reality. Now, I need to plant another cliffhanger because we're entering the final act. If foreign buyers continue stepping back, if domestic buyers stay cautious, if central banks become the primary absorbers of government debt, the entire structure of global finance changes. The old rules, the ones based on market-driven price discovery, stop applying. And when those rules stop applying, everything reprices. Bonds reprice lower. Currencies reprice lower. Hard assets reprice higher. And the people who see it coming position early, the people who don't get caught in the repricing and wonder what happened. Now, before we move into the final section, I need to mention the members-only video. By the time you're watching this, there should already be a members-only update published with deeper analysis and the latest developments bundled in one place. If you want that level of detail, join the membership and check it out. It also shows me who's truly following the work closely. All right, final act. Let's talk about what this means for you personally, because understanding the problem without having a response leaves you stuck. If bond markets are weakening and monetization is the likely path, the strategic move is to reduce exposure to promises and increase exposure to assets. What does that mean practically? It means questioning the assumption that bonds are safe. It means questioning the assumption that currency will hold value. It means questioning the assumption that the system will function the way it always has. Because when the buyer base shrinks and the central bank becomes the market, those assumptions are dead. Now, I'm not telling you to sell everything and hide in a bunker. I'm telling you to diversify your risk, to understand that a portfolio built entirely on the assumption of bond market stability is a portfolio built on sand. And when the tide pulls back, sand doesn't hold. So what does a more resilient portfolio look like? It includes exposure to hard assets. It includes geographic diversification. It includes assets that benefit from currency debasement rather than suffer from it. It includes skepticism toward crowded trades and consensus narratives. And most importantly, it includes awareness. Awareness of auction results, awareness of central bank behavior, awareness of capital flows, awareness of the signals that precede major shifts. Now, let me ask you a final set of questions, and I want you to answer them in the comments. First, do you think this weak auction was an isolated event or the start of a pattern? Second, do you think central banks will monetize to support bond markets, or will they let yields rise? Third, if monetization is the path, what do you think happens to hard asset prices? Your answers tell me where the community is leaning, and they also tell me what to cover next. Now, I want to bring this full circle because we started with a simple observation. A bond auction struggled. Demand was weak. The numbers told a story that the headlines ignored. And that story is about confidence. Confidence in debt, confidence in currency, confidence in the system's ability to keep borrowing without consequence. And when confidence erodes, it doesn't announce itself with a siren. It announces itself with weak auction metrics, rising yields, and a quiet shift in capital flows. Those are the signals, and those signals are flashing right now. So here's my final takeaway. The bond market is not just a financial market. It's the foundation of the entire system. When that foundation cracks, everything built on top of it becomes unstable. Stocks, real estate, pensions, banking, all of it depends on stable, liquid, trusted bond markets. And if those bond markets are sending distress signals, ignoring them because they're boring or technical or not headline worthy, is a mistake, because by the time the headlines scream, the repricing has already happened. The yields have already spiked, the damage has already been done, so watch the auctions, watch the central banks, watch the flows, and position accordingly, not with panic, with preparation. Subscribe if you haven't. Join the WhatsApp channel in the description for daily updates, and drop a comment, even just RJohnAG, to support the algorithm push. And here's my final question. If the foundation is cracking, how long before the structure falls? Think about it, and I'll see you in the next one.